Okay, let's get started, guys. We are 6 o'clock. Nasdaq is up a little bit. Dow is down a little bit. Audio's great. Thank you, Ezadine, a man who has nailed a Tesla trade. Well done, sir. I know you have absolutely nailed that Tesla trade. Anyone else been trading Tesla? And actually, I'm going to use it as an example in this webinar, believe it or not, because it was a good little trade. Thank you, guys. Beth, Charles, Ezadine, James, appreciate that. Okay, so let's get rolling first. So we're going to talk about adapting to market regime shifts without losing your edge. And listen, I wish I could give you a kind of perfect magic pill for this. I can't, but I'm going to share what I believe is the best practice for shifting regimes and how we adjust as traders. I've been through a lot of different regime shifts, and sometimes they're very, very painful, and you go, I don't really know what to do now. I'm kind of stuck. And sometimes there's slight adjustments and adaptations. So we're going to talk about that today. There's a quote here, and I think it's Linda Raschke, but I couldn't find it. I kind of thumbed through the Trading Sardines book there. Maybe it's there. I couldn't find it, so I couldn't attribute it to her. But I think she said this: adaptability is more important than consistency. Markets are dynamic. Your job is to stay in tune. And I think that's so key, right? And I told this, funnily enough, Ezadine will remember this. I told this story about this guy. And this was when I first started trading, so 2001, 2002, that sort of time. And the reason why I'm telling you the story is he used to walk with a limp, right? He had a really awkward limp. And back in 1990, the 1990s, we had dot-com boom. I missed that. I wasn't trading for that. I started in 2001, so I kind of seasoned myself in the bear market, so to speak. And a lot of people were making a lot of money. A lot of people were up a lot of money on paper, adding to dips. People were making millions on paper. They're just adding and just buying the stuff that was going up the most. And I heard loads of stories about this. Anyway, this guy, he walked with a limp, and I remember saying, don't mind me asking, what happened, pal? And he said, I got run over by a bus. Bus came in, swung, knocked me over, broke my pelvis. So, oh, nasty. He goes, nah, mate, no. Best thing ever happened to me. He said, when I was in the hospital, I rang my broker, said, bring me a phone, bring it, obviously landline back then. He's got a long bloody cord. Hello? Yeah, so, so-and-so, I need to close all my positions. I'm in hospital, I'm not going to be able to deal with this. And the broker said, you sure? Market's on our absolute tear. He was like, yep, just close everything. This was 1999, start 2000, when we were just ripping to highs. Boom. Whatever happened, sorted himself out. He was in hospitals for multiple days. Anyway, during that time, the market crashed. The market completely crashed. And he pocketed all that paper millions, crystallized that into from unrealized to realized. Fine, he'd sorted himself out for a good period of time in his life, and probably for life actually, because he was an older guy, so we got maybe other assets. So he was good. There was a lot of other traders didn't adapt to the market regime shift. They were buying dips, and of course on the way down, I've heard stories of guys who were just buying, and were up multiple millions and gave it all back because they didn't adapt to the market regime shift, because they got enticed into the market. It was a rampant bull market, and then when things shifted, they've not no experience of anything else, and so they were just dip buying. And of course, we all know, you go back and look at a Nasdaq chart from 2000, the floor completely got whipped away. 80 something percent drawdown, and all those paper millionaires ended up with nothing. And some people unfortunately lost more than that because they thought, hey, I'll just keep buying anyway. So the story of the guy with the broken pelvis and the story of the people in the dot-com boom who didn't adapt folds in nicely to what we're going to talk about today. Now, we've not had a rampant kind of massive, we had a bull run, to be fair, but the point is that the regime shifts, and we don't want to be calling from, we don't want to rely on a hospital admission to take us out of the market and lock in gains, right? We want to be able to, as traders, want to be able to adapt. We'll go from bull market to bear market to pullback to consolidation. There are different types of market regime, and we don't want to be a one-trick pony. And so we need to understand that as tough as the game is already, and I get it, right? It's tough. It's hard enough to find a strategy that works just now, let alone knowing that might not work in the future. But that's the game, right? We're being rewarded for playing a very, very difficult game. And so hopefully this webinar is going to give you some ideas and insights into how to think about this problem and a challenge, approach it with a solution-focused angle, and better equip you for market regime shifts. And I think it's very apt at the moment. I'm looking at my other screen, by the way, here. There's not someone standing there. Look at my other screen. It's very apt at the moment, isn't it? We have massive oversupply. We're talking about the US market, equity markets, overhang of supply, rampant selling, big flushes to the downside, further than anything everyone ever expected. Tesla 50% off, Nasdaq down, all these high beta stocks getting absolutely smashed, and we haven't had that for a while. Now, do we go into rotate back into bull market? Do we kind of continue the selling? Do we have a consolidation? We don't know this, but as long as we can adjust and adapt and play the game that's presented to us at the moment. Okay, so I must do this. I must do this before I get started, guys. I must, of course, remind you that we're in a risky business. We know this. You know this. If you don't know this, please double check the risks. We're trading with leverage, which means when things go right, it's very nice. It's very juicy. We all like it when things go right. Yeah, we put a small little amount of margin down. It goes our way. Thank you very much. When it doesn't, we end up losing that money. So just make sure that you're only trading with money you can afford to lose. I get multiple emails. I would not say a day, not quite that often, but I get a lot of emails from people who maybe trading with money they shouldn't be trading with. So please just consider, you're a big boy, you're a big girl. If you understand the rules of the game, you understand how this thing works, you understand the risks, you understand how we can manage risks, but we can't completely eliminate the risk. We understand that's the offset of the upside, then fine. You make your own risk-based decisions, and you absolutely should. But just please recognize there is that too. I hate anyone's coming to trading and they message me and go, I didn't realize how risky it was, didn't realize where the risk was, and that really breaks my heart, because if we all should know the risk we're playing, and we should understand what we're doing. You skydive and you understand the risks. You go into boxing, you understand the risk. You ride a motorbike around the Isle of Man TT, you understand the risks. Trading, you understand the risks. Okay, so very, very quickly, I know I repeat myself with this, but I know I've got some new people here. A pleasure to have you here. If you are here, my name is Mark Holstead. I run Traders Mastermind community. I don't know why I say that. I've only run that for 4 years, but I've been trading for 25 plus. And this was a recent thing in COVID. I started Traders Mastermind. So the reason I say that is not to say, hey, look, go and join Traders Mastermind. You can do. It's a free daily email. You're very welcome to. But it's to say, I think I'm quite well positioned to share with you my experience of trading through different market regimes. Markets treated me very, very kindly, but there have been times when things have been tough, right? And so I can share with you my experiences with the market and my knowledge and stuff, which I think is valuable from a couple of decades in the market, but also having seen traders who are developing and evolving, and seeing some people who just fall by the wayside, and some people who actually get it, start to put in green quarters, green years, green months, and see them adjust and adapt. And it's such a pleasure to see that. But I can also take that and share that with you and say, hey, I've seen this pattern of success in people. Let me share that with you. I've seen this pattern of failure with people. Let me share that with you too, so you can try and avoid that. But always, as always, take everything you hear from anybody online or in person, really, with a pinch of salt. And you say, you know what, that's quite interesting. Let me use that as a seed to maybe do my own research and look into it further. So I don't pretend to have all the answers, because I certainly do not. I don't pretend to be the most magnificent trader in the world, because I certainly am not. But I do have something to offer. I do have, something that I think is going to be valuable to you. So let's move on. Market regime. So why do market shifts matter? Strategies just expire, right? What worked last month is very apt at the moment. You might have been a dip buyer in the US equity market, which worked very, very well. Not necessarily last month, maybe the month before Trump got into office, and then just shifted, right? It became a headline risk. It became real overhang of supply, real pressure on the market. Lots of stuff was happening. And we had a kind of prolonged run after COVID, didn't we, really? And we had sort of little dips and maneuvers and shuffles, but the regime was relatively similar after COVID. We had a little bit of a blip in August the 6th, was it? We had the yen and the Japanese liquidity crisis. We have all these little blips, and maybe there's a mini regime shift. And maybe this is a mini regime shift now. Nobody knows. And anyone who pretends to know is lying to you, because nobody knows. We just have to adjust and adapt. And the volatility changes, trends change, liquidity changes, all that stuff. So we want to try to be traders that are very adaptable. We want to be able to adapt to any condition. Now, one thing I'll say is, if you're a developing trader and this is kind of new to you, then you really want to be giving yourself a little bit of a break and say, listen, it's the first shift I've seen. I can't expect to get it right. I'm going to try and help you today get it right, but you can't expect to get it right first time. Okay. And even the best traders, will lose a little bit on the shift, but you just have to. We'll talk about this in a moment, but let me go sort of ahead of myself a little bit. When we had this move lower, the correct thing to do initially was to start looking to dips to buy, because that's what's been working for the past many years. And then when it doesn't work, you have to adjust and adapt and say, hang on a second, do I need to now be more aggressive with shorts? Do I need to be looking at A to B type trades? How do I adjust? And we'll talk about that in a moment. But just remember that if it's the first time you've seen a regime shift, then you can't be too hard on yourself and expect to get it right. And I'm going to help you guide you, but just also think that as we get more experience, as the years go under your belt and the screen time comes under your belt, you'll say, I've seen this before. I know what to do here. I understand how the subtle differences in the way I should operate and the way I should conduct my trading. So just something to think about. So what is a market regime shift? And by the way, I must thank Armand for these beautiful slides he's done for me. Armand's the guy who helps me out managing the inbox and all the community manager and stuff. But he's done these slides. I think they're great. So what is a market regime shift? So it's basically when there's something significant has happened. We're always going to get pullbacks. We're always going to get adjustments. We're always going to get consolidations, backfills, breakouts. That's normal, right? But when a regime shift is when we get a significant shift in volatility, in maybe liquidity, maybe volume. Maybe we move from a trending market to a range-bound market. Maybe we move from contraction of volatility to expansion of volatility. Maybe we move to a headline risk environment like we have done recently with the tariffs news with Trump and all the kind of stuff that he's coming out with. He's setting this stall out. We've discussed that before in here. But, it's having to adjust and adapt. And a lot of traders ask me questions like, hey, how do I deal with these headline risks? Like you accept it. And why is it very, very unusual having this headline risk? It's not it's not something I haven't seen before. Maybe not necessarily from Trump, but we've had headline risk from other things before. Like I remember when we were capturing Bin Laden. Do you remember that was? What year was that? All the time you'd be trading and they'd say, we've caught Bin Laden, the market would spike. Oh, we haven't really. It will sort of drift down. So we've had all these kind of headline risks, and the yen used to be in focus, then it was gold in focus for a while, then it's the price of oil was in focus. So you'd always have this, there's always going to be something. So it's just understanding, trying to group it into your own category and knowing how to deal with it. So we don't want to recognize it too late, because most traders, I think, take too long to recognize the regime shift and end up doing maybe okay during one period of the market, and then as it shifts into another, end up giving too much back. Now listen, it's inevitable you are going to give some back, because by the nature of the beast, you're going to be pushing and pushing and pushing and pushing the same thing, and then you're going to say, hey, things have shifted, this is not working, let me pull back resources, let me not be too aggressive, and let me monitor. I'm going to go through a process for that in a moment, but again, I kind of repeated myself a little bit, but give yourself, accept that it is going to draw down a little bit when we shift regimes. Okay, so key signs of regime change. By the way, this picture on the left-hand side is one small box of my old trading journals. I've got boxes and boxes of these journals, and some of them have got strategies in from 15 years ago, 18 years ago, which are still applicable today, roughly speaking. Some have got strategies in them which are completely useless now, completely useless, wouldn't work at all. And the point is that you should start to log this type of stuff. You should start to think about how the regime shifts, what's causing the regime shift. So some of the signs that we look at, obviously volatility, we talked about that, expansion and volatility, contraction and volatility. Went through a period where we had really super contracted volatility, and at the moment we've got real expanded volatility. That's going to adjust the way you trade. If you're using a fixed stop, or if you're using a specific strategy and deploying that, you're just going to get smashed all the time. You're going to get cut, paper cut, paper cut, paper cut, or even full stop, full stop, full stop. That ignites frustration. That maybe causes you to trade on tilt. If you have a propensity to trade on tilt, a discipline issue, it can ignite all those other things. So the expansion and contraction of volatility. Same if you suddenly go to a contraction of volatility, you're looking for these extended moves. I'm looking for further targets. It's not giving it, comes back, stops you out at break even. That starts to annoy you, starts to wind you up, and you start to trade a little bit of a poor perspective. So volatility shift is, a regime change, or sign of a regime change. Going from a trending to a range market, or uptrend to downtrend, I think that's pretty self-explanatory. But when we have a broad, hey, we've rallied hard, now we're just consolidating, or we've kind of fallen through the floor, consolidating, those different kind of price structure changes, those are signs that we've shifted. liquidity differences. So sometimes, and this isn't always easy for us as retail traders to spot. And I appreciate that we're not all in tune with, the liquidity, and we're looking at the market depth and all that type of stuff. You don't need to be, right? Just keeping abreast of what's happening. Like a casual glance at the FT recently, or any of these news websites, you'd have seen that actually, a lot of the hedge funds are now no longer overweight in US stocks. So we've seen a lot of liquidity come out of stocks, and that's a considered decision. Now, are you going to make a trade based on that? Probably not. But what you might do is you might say, okay, that's interesting to me, because does that mean there's money on the sidelines ready to come back in? Does that mean that money is going to go into the asset that you trade? You have to think from a chess perspective and play the game of, okay, how is that going to affect me in a positive way, and how can I align with that? So macro triggers, these are things that regime change really, these are some of the big catalysts for regime change, right? Key events, obviously Donald Trump coming into power, big, big, big macro trigger, one of the biggest we've ever had. We all know the consequences of that in terms of tariffs, the headline risk, etc. For every different environment. Interest rate cycles, earnings cycles if you're trading some stocks, or if you're trading some of the companies, oil inventories, anything. Like we even had instances where I remember trading coffee. I've never traded coffee since, and probably will never again. But we had a period where you had this pest. I can't remember what the bloody thing was called now. It was like this pest on this coffee, on the coffee fruit, and it was killing the coffee plant, berry, fruit, coffee thingy, whatever the farmers will, I'm sure, correct me. I'm sure it starts out as a fruit, doesn't it? And then it comes into a bean. Anyway, the pests were killing this. And it was driving prices up, but it was a perfect storm because a lot of hedge funds were short coffee. And so you could see, I'm not saying this is a strategy to deploy, but the point is that was a regime shift of hedge funds going, oh, sugar, we need to get out of this. And we're having this external influence of price being driven up by this pest, this disease that's attacking the crop. So there's going to be much less crop coming out, prices are driving higher. That's a macro trigger. Admittedly, it's in coffee, and I don't expect anyone here to have traded coffee. Like I say, I traded it very actively. Then I've not traded it since, and this was a decade ago probably. But the point is, if you're the markets you're trading now, some of the FX markets, some of the equity markets, maybe even some of the commodity markets, right? These macro triggers cause a regime shift, and you have to adjust, whether you're a day trader or a swing trader, how you deal with that. You might have been used to trading certain volatility, A to B trade, running a trade, trading a stop, adding to a trade, and maybe you have to change that. Maybe you have to consider just changing the way you operate. Correlations breakdown. This is something as well. By the way, I'm getting blinded by the sun of that. I've got a huge window out there, and it's blinding me with the sun. I've ordered a screen, but it's not here yet. So if I'm squinting, that's why. Correlations breaking down. Risk on or off, assets decouple. We've seen this recently, actually. We've seen gold rallying, and then we kind of see it just completely decoupling a little bit from some of the traditional risk on assets like Nasdaq. When that was rallying, gold was rallying. So that kind of may affect things. Maybe you don't trade the correlations, but maybe you don't. And maybe these things don't affect the way that you trade, but they affect the regime of the market. And if we're trying to calibrate to the current regime, we should be looking at all these things and saying, hey, is the reason I'm losing at the moment just due to a system problem? Is it due to this? We'll get to this in a moment. Is it due to my execution? Or is it a regime shift that I need to recalibrate what I'm doing? And this is why we kind of scan through all these things. It doesn't happen all the time, but we kind of scanning through all these things. And finally, the sentiment flipping. So recently, and maybe you don't want to add too much noise into your trading, and I can understand that and appreciate that. But recently, we've seen sentiment flip to bearish. We've seen the financial news, especially if you look on something like Tesla, massively, massively bearish. Some sentiment indicators, they flip or undecided, and that sometimes can influence a regime shift. And you might be like, hey, on its own, it's irrelevant, and it might be, but actually, when you put it all together, it becomes actually something that's quite interesting. Just got a little bit of a shade there. Okay, so all those things are really important to recognize the regime shift. And if you're sitting here thinking, Mark, do you know what, pal? I don't want to be looking at all this stuff. I would say to you, okay, but hear me out. If you're a day trader of Euro USD, if you're a day trader of, dollar yen, DAX, DAO, whatever, this may not influence your day-to-day decisions, but just having your finger on the pulse of, has the narrative shifted, can adjust can change how you adjust the actual intraday strategies. We'll get to in a moment how we do that, but you might be like, it's not my thing, it's not my thing. I'm more interested in price and tape and price action and technicals. Yes, but this will influence that. I'm not necessarily saying alter how you trade, but you might want to recalibrate. Okay, let's go. So some of the mistakes I see people make is being persistent or stubbornly persistent, and carrying on the same strategy when it's not working. Now, this is when you kind of should know really, and I understand that when you're a newer trader, it's very difficult to know, is this a drawdown, an expected drawdown, or am I, is this the wrong strategy? And I get it. We'll kind of try to help address that in a moment, but I see that some persistent just keep buying dips, buying dips, buying dips, like the story I said before, where lots of paper millionaires buying dips, buying dips, buying dips, and not looking the fact the regime change has shifted, the sentiment has shifted. Like there was a catalyst. It was just a very, very different environment. Overreacting. Maybe you're guilty of this, of like, hey, it's not working, I need to adjust and adapt. We don't want to do that. We only want to adjust our strategy and how we approach the market when we see a regime shift. That's a considered decision, right? It's a very considered decision. It's something to do with your trading business. You sit down, pen and paper, and go, do we have a regime shift, or is it just a pullback and a week of down move and an uptrend? It's very, very different, right? And understanding that, so don't overreact. And then forcing trade. Sometimes it can cause frustration to build. You're not looking at the actual context of the market. Recently we had that heavy, heavy sell-off in US equities, specifically tech. If you were buying every fresh low there, you just get slaughtered. And then sometimes you're forcing it, going, and we're actually stepping back and going, hang on a second, there may well be a bottom here at some point, but I'm being an idiot by buying every fresh low, thinking this is the low. Let this play out and not force trades that aren't going to work. And yes, I'll miss that low, but actually I can structure something a little bit more cleanly. I'll give you a real world example in a moment on that. So something to consider. And the way I like to look at things is kind of your core versus adaptive framework. So core is your unshakable foundations, if you like, that you just never ever change. And the adaptive elements or the dynamic elements are the things that you potentially change depending on the regime, right? So the first thing you do is you say, right, my risk management should never change. My principle, my broad principles. So how much you risk per trade, per day, per week, per quarter? What's your maximum drawdown before you reevaluate your equity curve drawdown before you reevaluate? Some of those stuff that you absolutely must do. If you were trading at a firm and I was running the book and you were a trader under me, they would never change. They're like, hey, your risk is this. Just because the regime shifts, it doesn't mean you suddenly get more risk or less risk. Now, fine, it could be a considered decision. If you were trading very, very well in this new environment, I'd give you more risk allocation. But if you weren't, it'd be like, hey, that's the rules of the rules, right? So there's the core that stays the same. Now, do you adjust stop sizes and width? Yes, of course, you accommodate volatility. Trade selection criteria, ultimately they should stay the same. The core should be the same. And it doesn't necessarily mean that we shift into something brand new and go, I'm used to trading, cable, and now Nasdaq shifted. I'm going to start looking over there. Now, fine, if your edge is that, then do that, but don't shift to the most volatile asset just because it's moving. We talk about being seduced by volatility all the time. As traders, we're like, I'm trading this. Oh, hang on a second. That's sexy volatility over there in crude oil. You maybe never traded crude oil in your life, and you get sucked into trading it. You end up going to drawdown. Now, fine, if you're experienced and you can calibrate to that and adjust that. I know I talked about getting seduced by coffee volatility. But from an experience perspective, I knew how to manage that and how to trade that. So your analysis methodology, how you approach your day-to-day stuff, your pre-market routine, your post-market your post-market review, all that type of stuff. And adaptive elements, so how often you're trading, where you're placing your stop and the width to accommodate the increase or decrease volatility, or just the regime shift. It's very different trading a bear market to a bull market. You can't just flip it on its head and say, well, I'll just trade it as if it was an inverse bull market, because as you know, it's very, very different, much more fear, much more flushing, much more aggressive snapbacks. We don't get that to the upside generally. Position sizing, of course, goes with the stop placement, and then strategy emphasis. So what are you going to focus on? Are you going to focus on A to B trades? Hey, I'm going to trade a little bit more aggressively on a lower time frame because I don't really know what the higher time frame is going to do. I don't really want to sit through headline risk, for example. That's a considered pivot to adjust the regime, and you say, hey, I'm going to just focus on these shorter term strategies that I've got. So you're aligning with conditions, you're aligning to your strengths, and you're kind of trying to see what's the best way to deploy capital. So one of the things that was that E gun. Oh no, it's my mouse. I thought the E was funny there. So this is very quickly look at this. Volatile markets, you want to use a wider stop, smaller position size. I know this might be simple to many of you, but it's an easy way of just getting grip on stuff. Things change. Here's something that I'll mention. When things aren't going your way as a trader, the best thing to do, and by the way, it's never advice, I'm not here to give you advice. What I like to do, and sometimes if I work with a trader, I say this: strip out any variables that are going to have an impact. And what I mean by that is, if you're struggling to get traction, then get rid of some of the variables that are maybe causing the problem. So have a really wide stop with a small position size. And many people go, oh, I don't want to do that, but you're trying to diagnose the problem. If you just can't pick direction, right, that's an issue in itself. If you can pick direction, but you're a bit early or getting stopped, that's another issue, right? If you're adding to a trade and then getting stopped, then the add is the issue, not the initial direction. So to diagnose the fault, so to speak, you will take out and strip out the things that don't matter. So you don't want to be scaling into trades or out of trades. You want to be using a wider stop and a small position size just to see where you are. Years ago, I used to work on like cars and racing around stuff. And if you've had a problem with something, you isolate the problem and check this, then you check that, you check the other. You wouldn't just try and pull this and change this and adjust things just to try and see what happened. You go, hey, is it the injector? Let me see if that's working. Is this work? So you'd strip out all the variables and go, right, let me diagnose the fault, and then I can layer back in the variables. So wider stop for these volatile markets. Choppy markets, maybe not getting involved at all, and trending markets, fine. I've categorized this as a medium stop size and standard position size, but you trade what you're comfortable with. But going back to that point of analyzing and diagnosing challenges in trading, make life easy for yourself. Wide stop, small position size, no ads, no complexity. Just see if you can see if you can predict direction for an hour, 5 minutes, a day, whatever your time frame is. Generally speaking, and then you look at it and go, you know what, I'm too late to that. That's why it's not working. The risk reward ratio structure is no good. I'm too early. I'm getting pinged out. My maximum adverse excursions. And then you can work on that and say, okay, well, you know what? Why don't I just pump the brakes a little bit before I pull the trigger? Because that's going to solve a lot of the problems. Or you go, you know what? It's nothing to do with my stock placement. I'm just not getting direction right. I'm getting it all wrong. And then you look and go, well, actually, am I taking into account higher time frame? Am I reading this? Why am I getting direction wrong? But you need to know why you're making those poor decisions in the first place. And there's so many variables that come into play. Listen, I remember, I don't know, it's not story hour, not Jackanory story hour, but I remember trading the YM many, many years ago and used to use a 10-point stop because the range was just nothing, right? So Dow, 10-point stop. And I remember trading the strategy and it was working. This stopped working. I was like, man, this is really frustrating. Why is it not working? And I kept trading it and trading it and trading it. It was my early days, maybe 5 years in. I was like, God, man, I can't believe this. Anyway, I analyzed what was happening and I looked through my data and I was right, but my stop was just a little bit too tight. And so I widened it to 12 points. I know it doesn't sound much, but the range was so much smaller back then. And that kept me in the trade. And then I worked on being better at my entries and not being so aggressive and so early. But without that, I'd have just looked at the data and gone, this is rubbish. I'm just losing money. I'm just losing money consistently. My equity curve is awful. The strategy's gone. Chuck it out the window. But actually being able to analyze it and strip back and look at what's gone on and the regime was shifted, okay, I need a slightly wider stop. I know 10 to 12 points isn't a lot. It's like a blip at the moment. You could sneeze and it does 50 points to Dow. I appreciate that. But back then, that was what it was all about. Okay. Next one for you. So what adjustments are we going to look at? So I really think that expectations and what we expect from a trade need to be monitored regularly because we can all get into a habit of trying to hold trades, of just taking A to B type trades. And in reality, that's one of the biggest levers we can pull to improve our trading. So, many people come and say, "Oh, I'm trying to hold my trades longer. I struggle to hold trades." And my answer is always, is it the right conditions to hold trades? What is the market telling you that says you should be holding trades? Just because the odd trade has gone further than your exit doesn't mean you should be holding the trade, right? If it's a range bound market, it's chop, not necessarily chop because I tend to stay clear of chop, but if it's a range bound oscillation, mean reverting market, rotational type market, then absolutely you want A to B trades. You don't want to be looking to be holding trades for extended moves. You want to take what the market's giving you. It's giving these rotations. You want to trade the rotations and you want to try and catch as much as possible. You're never going to get it all, but your job is to go A to B, done. A to B, done. And play that game. But very often traders will go, well, I really want to hold my trades. I really want to hold my trades. Yeah, but the market's not offering that. And so you're trying to play a different game to the rules that are being put in front of you. You're trying to play cricket on a football field. You're trying to do boxing in a what would be the worst thing in a swimming gala, right? I know it's the most stupid analogy ever, but you get the point. And so you're thinking about how you adjust your trade and how you adjust your expectations of the trade and calibrate into conditions. And yes, if you're in a runaway trending market, you do want to be trying to stretch that holding time. You do want to be trying to get as much as you can out of the trade. And that should be something you work on, right? And if you're constantly taking A to B trades, then that's something that you need to work on. So adjustments with the conditions. And also if you're unsure, like if the conditions now, you're looking at the conditions now going, I'm talking about from the Nasdaq specifically here. Do we push higher? Do we push lower? Do we consolidate? And you don't know the answer, then don't force anything. Just stick with your range bound stuff and say, well, I still think I can play this A to B stuff, highs to lows. I'm not going to overstay my welcome. You have that as a kind of your own business model. And then when you feel, hey, we're running back to the downside now, I want to hold this for a capitulation, you do that. Or hey, we're fully reversed now, we're pushing back up the upside. You can adjust the suit, but that's calibrating to the regime that's in front of you. So when the market transitions, wait for the clearest signal, avoid trying to guess it, because I know guessing like kills so many traders, and it's such a shame because actually in the right conditions, they're very, very effective traders. Great example. I said I'll give you this Tesla example. This is a great example, right? So any of you, I know many of you don't trade US stocks, but maybe you've got an eye on Tesla, just fallen off a cliff, all sorts of reasons, right? Elon Musk, people don't like Elon Musk. The very people that were buying his products now setting him on fire, bizarrely. The charging with what's that company called, BYD. Anyway, there's loads of different things. I'm not talking about the pros and cons of Tesla here. The point is, price is king. Price has showed you it's down 50% from highs. Okay, now many people have been trying to trade the bounce, and they try to take it a few times, but there's a lot of people who buy again, buy again, buy again. They don't see the regime shift, right? And I appreciate we've got this hindsight here, but I know Ezadine has taken this trade. I've taken this trade. People have taken these trades. But the point is that the regime shift, you look at some of the bigger picture and go, hang on, the price is doing one thing and the narrative is very different. Buying dips is not working. Let me wait and let me see how this plays out, right? And so we had this situation the other day where this is down heavily, it's sitting and it's bear flagging, and everyone thinks it's going to go to lows. The sentiment is negative, like he's recalling Cybertrucks because of some adhesive issue. People are setting things on fire. It just worst case scenario, right? And we had more negative news come out, and on that day, the first green candle there, that was when we had more negative news and it closed on highs. Now, this is when the trade stands out at you and you say, hang on a second, this is acting completely differently to the tape. The tape is acting completely differently to the narrative. The regime has shifted, right? We've gone from really heavy supply, people dumping stock, to hang on a second, people can't get enough of this, even though we're in a peak kind of news, bad news. And so don't be in a rush to trade. Let the price tell you. And then you have an opportunity to say, right, I want to pick this up for a swing trade, or if you're a day trader, you go, right, how do I get into this? I use an opening range breakout on the long side. It was up big yesterday. It looked like it was strong even when it was negative news out. I'm going to take an opening range breakout trade and just trade it intraday. So why I say this is it's a very recent example. And the point is that just be calm. Like if you don't know what's going to happen, don't try and get involved. And the problem we have is Tesla was doing such big moves that it was seducing people into trading it. Oh, it's down, it's under 300, I've got to buy it. Oh, it's under, I've got to, no, no, no. And maybe it's hit and just a V-shaped reversal, fine, you miss it. And this applies to any market, by the way, it just happens to be Tesla that I'm showing you here. Don't be in a rush if the regime has changed and buying dips is not working, which was working very, very well, as you can see for the latter part of 2024. Buying dips, great. Profit, 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 small loss profit. Wow, you're a genius. But if you kept doing that now, you're going to lose money. So, when the regime shifts and you don't know, don't be in a rush. You will see. Just stay in tune with it and you will see with much more clarity when the opportunity is there. And it will shout at you. And if you're a day trader, you go, yeah, there's my opportunity. If you're a swing trader, you go, yeah, there's my opportunity. Okay, so strategy selection. Knowing your playbook. Not all setups work in every market. I think everybody knows this, but understand that, hey, I may have this playbook here. I may have these different trade ideas or these different strategies and setups and a mixture of filters and triggers, but I understand that they need to be deployed in the right market conditions. So we've got trending markets, obviously momentum breakouts, pullback trades, and also distinguishing between the two, grinding versus reprice. Reprice market is, wow, we need to kind of bid this up higher because the Fed's cut interest rates or Donald Trump said this or whatever it might be, versus a grinding uptrend and recognizing that's a different regime. A ranging market, we could easily just sit here for months now while things start to develop out. Who knows? And then you adjust to that and you say, listen, I'm not going to trade breakouts because if I try and trade breakouts, momentum expansions, or sorry, volatility expansions, momentum ignition trades, I'm just going to get stuffed. Every time I take a momentum ignition trade and it just fades back on me, you're just going to take a paper cut, a paper cut, a paper cut. And so saying, okay, my momentum ignition playbook needs to be put to one side for now, and I'll dust that off when I need to deploy it. At the moment, I'm playing mini exhaustions, I'm playing tape A to B trades, I'm playing little sentiment shifts, whatever it might be for you, and then deploying that and saying there'll be a time when that comes back into play, but not now. And being smart about how you deploy your assets and your resources, and think about all these different strategies you've got as different resources. Your playbook is that's a resource, that's a resource, that's a resource. An analogy I used the other day, I think, with a trader was, imagine you have a selection of businesses, right? You're an entrepreneur, and we're entrepreneurs ultimately with trading, right? We're making our own decisions and trying to solve a problem. But if you have a selection of businesses and you've got an ice cream parlor, you've got a tire shop, you've got an e-commerce store selling children's shoes or whatever, very, very different as we are with traders. Imagine each of those as a trading strategy. When the sun comes out and there's a hot spell, there's a heat wave, where do you put your resources? You don't put it into selling Wellington boots online. You go, the ice cream parlor, get over there, get some staff into that store, get some promotion going, make sure we've got stock. You push that as hard as you can. And then we have a rainy spell. You don't start trying to sell ice creams and sticking loads of staff in there. You go, I need to go back to my e-commerce store and start selling the Wellington boots, start promoting those, start giving discounts, start getting people through the door, and you adjust. And that's the same with trading. If you're trying to sell Wellington boots when this is the most weird analogy I get you, but if you're trying to sell ice creams when it's freezing cold, you're just going to struggle. And it's the same in trading. If you're trying to trade momentum ignition, if you're trying to trade breakouts and we're just stuck in a range and we're in an indecision regime, you're just going to get stuffed. And so being a smart trader and recognizing the regime you're in, or having a good estimate and a good idea of the regime you're in, and if in doubt, stay out. You do your audit of all the things we talked about there, the volatility, the social sentiment, the sense of the stories, all this type of stuff, the tape, and say, hang on a second, and unlike the weather where you can look out and go, it's sunny, I'm going to sell ice creams, not Wellington boots. You don't always know when the regime is going to shift or how long it's going to stay. But that's one of the things as being a trader is just trying to be smart and saying, okay, how can I play this to the best of my abilities? And don't forget, the default option should always be no trade. No trade, because that keeps you safe. Okay. So a couple of things here. Danger of overfitting. We don't want to overadjust, guys. Too many adjustments and you risk losing your core edge. And what is your edge? Your edge could be anything. It could be kind of the way you have discipline, the way you read tape, maybe, short-term price action, the way you incorporate higher time frame, all sorts of stuff. We're not going to go into too much detail here, but don't make too many adjustments. and constant tweaking. We just don't want to just wait, look at the data, and make. And honestly, one of the most simple things to do is obviously not trade by emotion and getting frustrated. But if your trades are not effective, you go, hang on a second, what are the things that I'm looking at that I think there's a market regime shift? And what's important to you? And you look at that, you look at price, and I'll tell you something. Sometimes just printing out your chart that you trade from a couple of days and sitting there without anything, no distractions, no phones, no trading platforms, and just looking opens your eyes to the truth of the market. So often we're caught up in the burden of performance. We're going to trade, we're going to trade, we're going to trade. I've got to perform, I've got to make money, I've got to make a trade. And we're so aligned with doing that, we don't actually see the patterns in front of us. And we get done for the day and we're tired and we maybe scroll out something on a journal and go to sleep, do it next day. Honestly, sometimes a massive unlock is just to sit back, no trading, and just look at your chart on a piece of paper and just go, you know what? What am I doing trying to get long here? What am I doing? This is obviously, we've had 4 or 5 days of down move here. I want to wait until this before I get long, or I want to do. And sometimes that really opens your eyes. So it's an exercise really worth doing. Some people are very good at change. They prepare for change, and I think you should do that too. Structure how you review and how you calibrate to change, and find that good balance. The very best traders find that. That's an awful picture. I appreciate that. The best traders find the balance of saying, okay, hey, what's my core edge, or what am I good at, and I'm able to adapt to condition shifts. So something you can do is to build a kind of system to help you and identify regime change. So spot the early signs with the kind of different variables I gave you before, and add your own. Like, I'm not saying that's an exhaustive list, but have something that's different to your day-to-day structure. You might day-to-day go, hey, there's my support, there's my resistance, etc. Think about things that are important to you. ATR, obviously volatility is increasing, correlations are shifting, talked about that, trend is shifting, price action is different, narrative shifted, all those kind of stuff. What's your market awareness system? Because very often, guys, we see the market do something, but the whole regime's the same. The interest rates are the same. This is the same. The regime, the government's the same. Everything's the same, but we're just seeing a down move. And that's not a regime shift, or what could turn into one, but it's unlikely to be. It's when there's other external factors, and we're seeing, hang on a second, there's much more concern here. I'm looking at those, and there's not something you look at every day. It isn't. But when I say that, sometimes we do get intraday regime shifts. That's probably a separate topic where you kind of go from trending and then you go to kind of a mean reversion and being able to adapt to that. But that's a kind of slightly different calibration approach. Okay. So yeah, I wanted to point this out. So this was the S&P, right? And this is a weekly chart. And many of you are like, well, geez, weekly. I don't look at a weekly very often. But sometimes things are staring you right in the face. And I'm not saying you get short here and everyone's going to kill it, but the regime shift of saying, hang on a second, this is S&P futures, by the way. That's the biggest volume we've done for a long period of time, and it's the biggest range we've done for a long period of time on the weekly. There's something going on here. So maybe next week I don't want to be just buying every dip. Maybe next week I want to widen my stop a little bit. Maybe next week I want to calibrate to this, and that's when you get out your chart that you like to trade and go, well, hang on, what has been working? Let's assume we're in a different regime here. What has been working? And again, I wish I could give you like a silver bullet and say, yeah, you just look at this and all of a sudden you flip short. There isn't something, and you know as well as I do that's not the case. If it was, we'd all be, wealthy beyond. We're overtaking Warren Buffett, saying, "What are you doing still investing in companies, Warren Buffett?" We should look at this one indicator, mate, making 100% right trades, like the Instagram crew. What are you doing, Warren Buffett? It's not the case, but there are clues that help us calibrate a little bit, at least keep us staying out of stuff. So, emotional discipline, right? This is very, very important. This is very, very important. Very often we change, and fear causes us to panic about adapting. Fear causes us to go, oh gosh, it's not working anymore, or things have changed, I can't get anything right, and we then rush the process. That Tesla example there. If you rushed, you tried to buy, Maybe you went short, late. Maybe you end up doing something that's going to cause damage, and you've got to be calm and think calmly. Imagine you're operating and running, a multi-million-pound book, right? By giving you this risk allocation, I don't. No one expects you to suddenly panic and start making a rash decision. You sit down, you take a few days to recalibrate and say, hang on a second, things are not the same as they were before. How can I adjust and adapt? Do I need to do anything? Do I need to stay out, or should I be adjusting and adapting? And also just remembering that data should drive your decisions, not emotion, right? We don't want to have an emotional reaction. Hey, things aren't working, my equity curve is getting smashed. We'll solve it. You're in the game of risk, right? You're here because you want to extract money from the market. That's not an easy job, and nor should it be, because the rewards are handsome when you get it right. If you get it wrong, there are consequences. But emotional decisions, which every human being does, are never going to serve you, because anyone off the street can come in and trade emotionally, and if that worked for them, then we wouldn't have edge, right? It wouldn't be the elite amongst us. So you have to understand that analyzing the data and analyzing what's happened and making the best decision you can with the information you've got in front of you is what trading is all about. And yes, we're human beings, we are going to feel emotion, but making an adjustment and going, well, I should just be shorting this, or I should be doing that, just because you've had a bit of a drawdown isn't the way to go. It's being calm about it and making that considered decision and saying, hey, this might be wrong, but I've got my risk capped. I know what I'm looking for. I know how I'm going to trade things. And just understanding that, we are rewarded for uncertainty, right? If you want certainty, we go and buy a government bond, we go and stick your money in, a high interest savings account or whatever, and you maybe live off the interest. Well, you're obviously going to get smashed for inflation, but that's certainty, right? You've got 99.9999999% of getting a coupon if you buy a bond from UK or US government, right? But that's not why you're in trading, right? We have to embrace uncertainty as in an exchange for the potential high rewards. If you want to make 10 times your money on a trade, a 10-hour trade, you better know that that's going to be a tough trade. You better know that your emotions are going to try and hijack it. You better understand that there's massive uncertainty there, but you're rewarded for that uncertainty. And so when these regime shifts and they catch people out, people get trapped. And we see, Tesla's a great example because it was there the other day. Everyone's bearish, the sentiment's bearish, and then all of a sudden it just rips to the high side. Maybe that's not your thing, that's fine, but just recognizing that the uncertainty of everything is where the reward comes from. Okay, so quick checklist here for you. Is it a fluctuation or shift? Is it just normal fluctuation, or is it a real big market regime shift? And we never know the answer for sure. Absolutely, we don't, just like the guys from 1988, 1999, 2000 didn't. They thought it was just a dip buy. But has something changed? You might not get it right, but at least if you're checking all those major variables we talked about before, you can make a better, more of a considered decision and say, hang on a second, and think about the worst case scenario, right? The worst case scenario, if this is the dip that you don't buy, you normally used to buying, you can always buy later on. You can always buy a bull flag. You can always get back involved again. Better to stand out and preserve your capital, most mental, emotional, and financial, and live to fight another day than try and get everything right. And there's a trader, actually, I'm trying to remember the guy's name now. There was a big trader the other day, like a real big 100 million plus type trader, who was saying he didn't know what's going on at the moment, so he stays out. Yeah, so it's absolutely fine to stay out and let things become clear. Like, let things become clear. And maybe you don't get the best price if everything changes, but sometimes clarity. And us, end of the day, right? Our job is to take money out of the market in a predictable manner, or as predictable as we can. And we're playing this odds game. And if we're saying, hey, and that doesn't matter whether you're taking it from the low print to the high print, or you're taking that high probability chunk but taking it more size, it's the same. But the bank manager doesn't go, hey, hang on a second, Mark, did you buy the low tick of that? Oh no, I was a little bit late and I bought the bull flag and held it a little to the highs. Oh, I can't take that deposit, pal. You have to have bought the low. Of course it doesn't, right? So think about that as well. Your objective is to take the high as an active trader, as a day trader, as a swing trader. That our job is not to invest. Our job is to take the high probability chunks, or that's a 15-minute move, or it's an hour move, not necessarily the whole day move or whole weeks of move. And also think about emotion, evidence or emotion. Is that causing you to make the decision? And just thinking in the cool, calm light of day when the market's closed, is emotion driving my decisions here? Because if it is, I need to back off. I need to just calm down and look at the evidence. Okay, so final takeaways here. Think about the core versus adaptive framework. What should stay the same? Your discipline should stay, sorry, the risk management should stay the same. Your absolute risk, the trade risk, weekly risk, quarterly risk, drawdown equity, etc. What's dynamic? How do you shift from A to B to momentum type trades, this type of stuff? Where do you want to focus your energy? Because ultimately, we have limited resources, limited amount of capital, limited amount of focus. And we forget that as traders. Sometimes we sit in front of the screen all day long, expecting us to perform, and we wonder why we kind of make a really crappy trade at the end of the day because our focus is diminished. So think about your risk management, how frequently you're trading, your strategy selection. Where are you going to focus your energy? Are you going to say, hang on a second, I think I've got a handle on the strategy selection here. My risk is a little bit out of kilter. Okay, I'll focus on that. And then market awareness. So seeing those shifts before they impact performance. And like I say, you never can, let's say never in trading, but it's rare to be able to a regime shift. If you've been doing well in one regime, you're going to give something back when the regime shifts because you're not going to magically stop doing what you're doing. But the quicker you can adapt to at least pull back the allocation of risk and go, whoa, 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 things aren't working. The same intraday, by the way. If you've been sitting there trading that A to B rotation around the VWAP, all of a sudden it breaks out to highs and keeps going. You don't want to be the idiot who keeps selling that new high, hoping it comes back to VWAP when it's broken out and it's actually doing a volatility expansion, range expansion. So, understanding you might do the first one and get stopped and go, whoa, whoa, hang on a second, it's just changed. I can see it clearly. But if your emotion make that dictate the decision for you, then you're going to get caught up in things that you don't want to do. So, market shifts happen. Just try and learn to adapt. Okay, so um, we've covered quite a lot there, and I recognize I've gone quite quickly. If there's any questions, I'll do my very, very best to answer them. I don't know everything, absolutely not, but I will definitely do my best, or I will guide you to someone who does. I know a lot of people, a lot of resources that can help you out there. So if you want to ask questions, you can do while you are adding your questions, ladies and gentlemen. I want to give you some action plan if you want to do this. Look at your last 20 trades and say to yourself, hang on a second, like are these aligned with the right conditions? And yes, when you're reviewing, sometimes you have the benefit of, you always have the benefit of hindsight, and you shouldn't let that pollute your decision. But just look at are you? I mean, I've been still been situations where I'm kind of pressing one side, and the market is completely, and I look at it and go, why am I pressing the short side here when we're bouncing, or why am I pressing breakouts when we're obviously mean reverting? And so it's not. Listen, trading's not easy. You're going to make these errors, but the quicker you can audit and go, hang on a second, I need to make an adjustment here, the better. And what's the perfect scenario? Like in the perfect scenario is I do this, and then reverse engineer that. As I say, the perfect scenario is I kind of bought this breakout here. I still thought we were mean reverting, so I didn't. So how can I reverse engineer, and what are the clues that define that actually we could be breaking out? What's a non-negotiable for you? Your core element. What's an adaptive element? And back to that kind of third slide. How are you kind of gauging if we have a regime shift? That's probably the most important slide of the webinar tonight. Is what do you look at to say, I think we have a regime shift because of this, the volatility, the ATR, the headline, what I'm hearing about how money's being pulled out. Okay, fine. So how do I adapt to that? You're never going to get it always right, but I think just having that as a trader, I think like a hedge fund manager, right? These hedge fund managers have made the decision for whatever reason there's a regime shift. Now, whether they're right or wrong, we will soon find out in the next couple of months or next quarter. They've pulled a lot of money out of US equities. They are now, I don't think they're underweight, but they were overweight before, and that paid off. But now they're neutral. Now they're pushing money into Europe. We've seen a lot of bid in DAX, a lot of bid in defense stocks because obviously Europeans are kind of pushing money into that. But the point is that they have, whether it's right or wrong, doesn't matter so much. But they've sat down, they've had a meeting with all the different people, and for us, it's like a mental meeting. And they've said, hang on, the regime shifted. Donald Trump is in power now. We have the headline risk, we have tariff risk, we have this, we have that, we have the other, we have overvaluation. Whatever they've come to make the decision, okay, we'll make a considered decision to reduce our Tesla exposure by 20%. We're going to reduce our NASDAQ futures exposure by 50%. We're going to, and then they've made the considered decision, not an emotion, to shift the allocation. And so for us, that's the same first part of that meeting, if you like. But the decision is, okay, well, I'm no longer going to be buying breakouts to the upside for the time being. that goes in the kind of pending folder. I'm going to look to kind of short fresh highs. I'm going to look to kind of trade mean reversion when we're in the inside day, but I'm definitely not going to trade momentum ignition to the high side until we see this. And that active decision, rather than kind of relying on your judgment intraday to guide you, which you often won't, often won't. Having some sort of checklist. I think just honestly, often the case with trading is to get off the screen in execution and start thinking. And the pie chart I often come up with is, the best traders, they spend most of their time thinking, researching, planning, analyzing, strategizing, and very little time executing. Traders who are struggling have the other way around. The pie chart is flipped. They spend all their time trading, moving a stop, trading again, trading. Maybe should I say, spend a little bit of time journaling, running through a checklist or whatever. Flip it on its head. The more time you can think and let the your experience you've got, whatever that may be, come out and plan and think and make these considered decisions, the easier the trading will get. This slide, discipline tracker. Many of you have got this already. I know you have. If you haven't, it's free. It's a Google Sheet template. You can copy it to your Google account. You have to have a Gmail account or Google account free. Go to tradersmastermind.com, click on discipline track. I think it's top right. Enter your email in there. I'll put you in the daily email list. You can always jump off that. You don't like that, but you get this discipline tracker. And the reason I can include this all the time is the feedback from this is fantastic and it's free. Like I've done this, I've had this designed, and it helps loads. If you're struggling with discipline, if you're trying to kind of align yourself with one route of trading or trying to focus your energy, it's a very, very easy sheet to fill in. Simple Google Sheets kind of application, from where that's like Excel. And if it just moves the needle a little bit, then it's worth doing, right? Okay. All right, that's it, ladies and gentlemen. We've got a couple of minutes for Q&A. Okay. Thank you, guys. Thank you. Appreciate you all. By the way, next week, can I talk about? We've got a really good topic for April. Really good topic. You are going to love this one. I've put a lot of thought into this, especially with the current conditions. How to basically, it's just taking everything to the next level. So if you are an intermediate, advanced trader, you've gone through the basics. This next month is going to be just for you, and I'm certain that some aspects of that are really going to resonate with you. So yeah, more details to come out. Make sure you're on my email list, Pepperstone's email list, etc. You will see full details of that as we finalize some of the timings and stuff. But yeah, I've been putting a lot of effort into that one, as I do hopefully for all of these. Hope you guys get value from it, but you're really going to enjoy that. So make sure you subscribe to that. Okay, I don't think we've got many questions here. Victor says, cheers, Mark. Great one and nice slides. Thank you, Victor. I shall pass on the appreciation to Armin, who've done these. Okay, Marcus, opinion on back testing and building the best system to do so. I track via Excel and link Notion for detailed screenshot analysis. Hey, good for you, Marcus. You're doing the right thing, pal. You're doing the right thing in terms of tracking, in terms of analyzing and adjusting. Now, one thing I think about is that back testing can serve a purpose to build confidence, but regime shifts, there's nothing beats forward testing, i.e. just running it and trading it. And if your risk is capped, I think that's the best way to go. Now, I'm biased with this because I prefer to come up with an idea and trade it almost immediately. I'll come up with the idea, I'll see something, I'm going to trade that. And I think, how much risk caps am I allocating to that? X. Am I happy with that? Yes, okay. Because I think sometimes when you back test, you overcurve fit and your expectations are too high. Now, I appreciate that for a lot of people, back testing is exactly the right thing to do. And I get it. You should absolutely back test. But track what you're doing. Link screenshots are great. Build that playbook out. I think building the playbook out and saying to yourself, hang on a second, I know I've got a selection here of charts that exhibit this momentum ignition strategy or this, or exhibit a kind of volatile expansion, whatever. And the more that you can have those screenshots, the more you can kind of build your Notion database. Perfect. Evernote, doesn't matter what you use, but the better. Yeah, don't worry too much about backtesting too much. I know some people disagree with me on this, but I think just getting some skin in the game. And again, it's not an incentive to encourage you to trade at all. But for me, it's always just go. Let's just go. I see something, I want to trade it. We're regime shifted. And look, if you kind of overanalyze what happened the last few weeks, you're too late to the party. You want to be like, hey man, there's a little overhang of supply here. We're trapping people to the upside. Let me short these fresh lows. I don't need to backtest it to know that's probably going to be effective strategy until we kind of run out of steam to the downside. That's a good question. Okay. Thank you, Alison. Great webinar. Let me start from the bottom. That's fair to everybody, isn't it? Zach says, how does your entry criteria change? I use the 1 minute candle to trigger me into the trade with a candle type such as bullish or bearish candle. I don't know how you're defining that. Okay. When volatility got really high, my entries became less frequent as the market would just move so far so fast. Very good question, Zach. Okay, so from an operations perspective, if you have that 1 minute candle triggered, I'm assuming you wait for the candle to form and then you take the trade and you said, hey, a bullish candle, bearish candle, whatever that may be. I assume an ignition type candle. Two ways to adjust that. One is you take it on the chin and widen your stop and calibrate and say, hey, I still think there's plenty of upside here. I'm just going to have to accommodate that risk. Or you say, there's my entry. I'm going to bid 10 ticks under that, 15 ticks under that, and constantly drag that up and say, hey, I know it's moving far and fast, and by the time I've clicked it, I'm going to be paying right up at the highs. I'm going to be the mug who's paying full retail for this, but I still think there's more mileage, but then it ruins my risk reward ratio structure, all this type of stuff. So one thing you can do is use a fixed kind of trail. I know you have to kind of adjust it, but if you're on the button waiting, you're like, hey, you see it drive off, you say, I'm buying a 10-point pullback in this, 15 clip pullback, I'm buying. You're waiting. Even though it goes up, you're just buying a little bit of a discount. And that just gives you a little, just allows you to smooth off that volatility and that aggression a little bit by just not chasing and not chasing. You see the move, you see the momentum, you want to be part of it, but you're not going to have to pay, you don't have to pay right up. Now, sometimes, of course, that means you have to pay higher, but you still get the spring contracting back a little bit before you're in. It's something to consider. And obviously, you need to look at that for your own approach and all the other good stuff. But that's something I like to do myself. I hope that's made sense, Zach. But thank you. That's a great question. Um, well, this is another good question. Jacob, great webinar. Thank you, Jacob. I feel that these changes happen on an hourly basis when you're scalping. You have to consistently pivot and change strategies or sit it out. 1 hour trading NQ on the 10-second chart, you live through it all. Mate, you wild for trading on a 10-second chart. But yes, to the point, it does. Structure changes intraday, and that's perhaps another topic, but being very, very aware. And here's a way you could approach that, Jacob. You either become a specialist in one environment and say, hang on a second, the changes are shifting a lot. I only trade when I see exhaustion, or I only trade when I see it calm down, or whatever it is for you, and you leave the rest. And that just preserves resources a bit. And I think you'd find that you probably do better because if you're trading on a 10-second chart, fair play to you, trading on a 10-second chart, then there's loads going on, massive volatility expansions, tape running, tape pulling back, wicks, and say, okay, what do I need to see for me to trade? An example might be, this wouldn't be my thing, but example might be, I want to see it as breakout slowly pull back to a moving average or whatever you use, or an oversold stochastic on a 10-second. I see it curl and then I go in. And so you become a specialist at that minute setup, even though you're trading, there's lots of information coming at you, rather than saying, okay, sometimes I fade, sometimes I do this, and you're kind of flying by the seat of your pants. As a scalper, you're so much more effective if you can say, right, this is my job, and my job is this, this, and this. Okay, it's not all these things. Because you're like, is it a breakout? Is it a fake out? Should I chase it? Should I wait for a pullback? Should I go long? Should I go short? Too many decisions to make. Whereas if you go, hey, I buy breakout pullbacks, and a 10-second chart, you might get a lot of those. And so you wait and you say, what do I need to see to make me pull the trigger and to risk capital on that? Okay, I need to see a breakout that's not very, and it's reasonably quick on the break, but kind of grinds back. And then I buy when I see it flip into the first green or whatever it might be. And then you're doing that, your trade frequency is lower, but you also kind of keep your resources, and you're much more, you're anticipating rather than reacting, because the danger you have, Jacob, when you're scalping on a 10-second chart is you're constantly reacting. The market goes boom and you go, oh, market jumps and you go, how high, right? Or the market says jump and you say, how high should I say? Whereas if you're very calm and you're very precise about what you're looking for, then you're still going to get very, a lot of trades, but they're more considered, and you're not kind of feel like you're chasing the tail and you feel anxious and all that type of stuff. And you're going to be more in tune with the condition shift as well. I hope that made some sense. Beth says, thank you so much for a great webinar. Thank you, Beth. Appreciate you. You're always here, so I do appreciate that, Beth. I recognize these, some of you guys who are here regularly, and it is appreciated, of course. Eduardo says, opinion on, let's say you're a momentum or trend continuation trader. How do you adjust on trades taken on daily, weekly conditions change? Can you just set back for 3 to 4 or 5 days out of a single trade? Yes, Eduardo, that's exactly what you do, pal. You go, you know what? I have not got a clue what's happening. We don't know if I'm going higher, lower, shifting. I'm not trading it. Let me sit back, and you will be amazed at the clarity you get from just resting for a period of time. Honestly, if in doubt, sit out. And I know there's a little voice in you going, yeah, but Mark, if I'm not trading, my equity curve's not moving in the right direction. That's true. I know that's true. However, it's also not moving in the wrong direction. If you don't have edge, you have negative expectancy. If you have negative expectancy, you're going to lose money over time. So why not sit out, recalibrate to conditions, look at it objectively without the pressure of performance pressure on your shoulders. Things become so much clearer. No trader has ever taken a few days off and gone, I wish I'd never done that. Okay, might be the odd one or two when they've gone, that's my perfect setup. But in reality, if you're in a position where you need to take days off, you probably should listen to that. Marcus says, great answer. Thank you, Marcus. Alison, great webinar. Thank you. Eduardo, hopefully I've answered that. Zach says, what's your candle entry trigger, or you just use levels? Zach, yeah, levels are something that's working at the moment. Again, do your own research on this type of stuff, is when you get this situation where you get a tail formed and price kind of bounces off and everyone's like, oh, that's the low, and then it starts to dig into that tail or eat the tail, as Linda Rashke says, and then you go, hang on a second, it shouldn't be here. And very often then you can front run the break, and then get involved in the break. So the little, and okay, that's just a kind of a loose example, but I think that your job, Zach, is to really look at the chart time frame you're trading on 1 minute, I think you said, and look at it, print it off if need be, go old school, and just say, hang on a second, is there something here that I'm not seeing in real time? And there'll be something you're not seeing in real time that you can deploy in your own trading. You go, hang on a second, that candlestick shaped here, if I get a doji, I get this, I get that. Very often the break is worth taking, and it's worth paying up for it, or it's not worth paying. I just want to take the actual, the price break or whatever it might be. But that will help you calibrate to the conditions that the conditions we're in. Marcus says, forward test 5 days a week, back test 2 days a week. Hope that's enough skin for the game. You need to add another day in the week, Marcus. There's more than 7. Yeah, perfect, mate, perfect. Zach says, do you only trade mean reversion or also breakout continuation trades too? As developing trader, would you recommend only one type of trading? As a developing trader, I think you stick to one or the other. And I think that, and this is very personal, so take it with a pinch of salt. I think that you can become, the danger you have when you're trading. Here you go. Here's the answer. The danger you have when you're trading breakouts all the time is you don't get enough decent ones to get enough reps in when you're a developing trader. And what I mean by that is the best breakouts, most of them are going to be fake outs. So you have to be very, very clear on what you're looking for, and you have to have the right conditions. The daily chart has to be setting up, and the intraday chart has to be setting up, and all this type of stuff. And you take the trade and you go, yeah, here we go, I'm going to break out, and you get a decent run from it. But that doesn't happen often enough these days. Arguably, the last few weeks to the downside, you could have, fine. But I think if you're trying to get repetitions in and get market exposure, again, controversial perhaps, I think you're better off focusing on mean reversion. I think you're better off focusing on times when the spring is stretched and it's going to pull back. Now, that doesn't necessarily mean fading fresh highs or fresh lows. To me, you can still trade in an uptrend or downtrend and trade mean reversion. So say you've got a big uptrend and it kind of comes back and you're kind of buying that spring as it's kind of pushing back up. It's not breakout trade. Now, if you choose to kind of hold for the breakout, it's fine, but it's very different to buying at fresh highs, right? You're trying to find that turn. You're trying to see the price action at that low, whether it's a VWAP, whether it's a prior level. And so even though you're trading with the trend, you've still got that kind of flexibility of it's almost a mean reversion trade because even though technically I know it's not, but that's not a breakout. So I think that's really where to focus. You get much more of those. And when volatility contracts, you can then look to sell highs and buy lows and go, where's the low likely to be for the day? What's the range likely to be for the day? It helps you get in tune a lot more, I think, with breakouts. And I think breakouts as well there's nothing wrong with them, absolutely. But if you're saying where to focus, which was your question, I think that breakouts they're very seductive because you think you're going to get a lot of profit very, very quickly. You think, if I just take this breakout now, I'll get a quick 20 pips and I'll eat 20 points, whatever you trade. And it seduces you into taking breakouts. And often you can take a breakout, you take a stop, you take a breakout, you take a stop, you get pot committed. You've had 2 or 3 bites of the cherry, and you go, I kind of have to take it now. I think it's going to break, and that can cause you to trade on tilt as well. So I don't think there's anything wrong with analyzing it and maybe looking. But if the question is purely, and again, a personal opinion, developing trader, I would try to find the rotation levels. I'm trying to find places where the market turns, whether it is at highs on a range bound day inside type day, or whether it is kind of at a VWAP or a kind of 50% retracement level on a range expansion day, and you're trying to find the turn. So anywhere where you're trying to find the turn as opposed to the explosion, I think it's probably better for getting reps depending on what you're comfortable with, number one, and the conditions and your level of experience. Jacob says specialized. Yes, thank you, Jacob. Charles says, thank you for the webinar. Nice to listen to you. See you next week. See you, Charles. Eduardo says, Mark, last 2 questions, guys. If you're still here, appreciate you. It's 7:15. Mark is not doing much, is it? So, Mark, sometimes I get confused if I should do 1 minute or 5 minutes. Some momentum trades is worth using the 1, others it's worth using the 5. Also, depending on products, Bund versus DAX, for example. What's your take on this? Bund. I've not traded Bund for many, many years. I would always go in the higher time frames, Eduardo. And the reason I say this, 5 minutes, sorry, 1 to 5, I think you go too high, you lose a lot of the obviously the picture gets lost. But you can still see price on a 5. And so for me, I like to look at a 5 and say, hey, I can still see the price moving. So I still, when I'm in tune with it, I'm saying, right, the 5's at a level I want. I'll be watching the price then. I'm not looking at the chart. I'm looking at the price on the right of the chart changing, and that will make my decision. I think you can go down to a 1 when it's coming into your zone, the area that you want to do some business at potentially, and fine, you should do that. But if going down to the 1 causes you to overtrade, which it does for many traders, and causes you to get false positives with your signal, then always go up. I prefer you to miss trades and take the good ones rather than taking loads of bad trades, if that makes sense. If that means going up to the 5 minute, then I think so be it. And the 1 minute can be super, super noisy. Sometimes we see stuff in a 1 minute, like, hang on a second, this is nonsense, man. Look at it in perspective, it's done nothing. So I'm always an advocate of moving to the 5. If you think you've got a special edge on the 1, then by all means stick with the 1, pal. Okay, Zach says, makes sense like open drive below. Makes sense like an open drive below previous day's low, for example. Very specific circumstances for continuation trades. I mainly focus on like mean reversion trades, but I do have specific reasons to continue. Good way of looking at it, Zach. I think I've got everybody here. I think I have. Zach says, I have a psychological issue overthinking. This caused me to lose. Okay. I want to spend 2 minutes on this. If you have to go, guys, I appreciate you understanding, but this is important. Zach, I want to answer your question for you, mate. So overthinking and its cause, and let me rewrap the question for people listening. I think you can see this if you can't. So Zach has a psychological issue of overthinking. By the way, I think I did a webinar completely on that, so go and check that one on, Zach. But it caused you emotional swings in confidence, further mistakes from greed and anger. You lost an evaluation account. You're attaching P&L way too much due to deeper reasons I won't get into. I'm now attaching my self-worth to the process now as a person. Okay, so it's a good start. attaching your self-worth to the process and your actions rather than your outcome. And you must do that forever as a trader. That's not temporary. You must do that. Otherwise, if your emotions are tied to your equity curve or P&L, you're a rotten man to live with for yourself and your others, right? Because we all go through rough days, rough weeks, rough months, and you can't attach your self-worth to that. Now, here's something to consider. Overthinking, um, the logical answer to this, Zach, is to say, hey, you can't solve the market. When you're overthinking, you're believing you can solve the market. You're believing you can find something else and, oh, should this trade be right? Should it be wrong? Your job is to execute your strategy. Nothing more, nothing less. It's not to make profitable trades, it's to execute your strategy. And that should come out in the wash with profitable trades. If it doesn't, you adjust, you tweak. So something you can do as a hack, if you like, is to say, hang on a second, I've got a very clear strategy here, and that's important to define that. I'm just going to execute for 10 trades, then 20, then 30, then 40. I'm not going to look at P&L. I don't care what that looks like. I'm just going to execute, and these are the parameters I look at, etc. And start to visualize that as a process. Start to think before the trading day, that's the job in hand, and I'll feel like it's a success if I follow the process regardless of P&L. Take any vision of P&L or any kind of display of unrealized or realized P&L off your screen. If you need to, use a post-it note to cover it. Disconnect that completely, right? If you can do that, and you can start to decouple yourself and start to not attach your self-worth to each individual trade, you'll be so much freer to operate. And I think you've mentioned it, like you're attaching self-worth to a process, rather than the outcome. You absolutely must do that. And it takes some work, it takes some time, but the more you can do this in the cold light of day and you can calm yourself and you don't have the emotional pressure to perform, and especially if you're trading on short time frames, I missed it, oh damn it, la la la, and you get all anxious. The sooner you can think through that problem in your mind and program your subconscious when the market's not chugging along, the easier that will be. And it's not an instant fix. And give yourself that flexibility as well. I know you're a driven man because you're trading. Everyone who's driven is trading, right? You want more, want. I get it. But this is where you have to have a little bit of compassion rather than compression, and say, this is not going to be an overnight fix. I can't the weekend suddenly go through a checklist and expect to be perfect the next week. I just need to be a little bit better, less overthinking, less. And over time, that incremental improvement will get you to where you want to be. So if you're a little bit calmer on yourself, a little bit more relaxed about the way you approach it, you've got to kind of approach a trade with a shoulder shrug. I don't care the outcome. Not too nonchalant, but I don't care what the outcome is. I'm taking the trade. It's all good. Let's see what happens. Got my risk capped. Here's my entry. Click. There we go. Okay, stop in place. My target. Push your chair back. See what happens. And the more you can become relaxed to it and less anxious, the easier that overthinking will become. Okay, I've overrun, but hopefully you find it's valuable, guys. I love doing these webinars. Thank you for coming on live, and your questions have been brilliant. I really do appreciate it. So we'll call it an evening there. Let's see what the market does over the next couple of days. I'm back again next week with a cool new topic. So make sure you are on the email list so you can see that. Appreciate you all, guys. Take care. Goodbye.